Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Dawood, and today's guest is David Morgan. David is the editor of the Morgan Report. He is also the author of a new book, The Silver Manifesto. David, thank you for joining me.
Well, thank you for having me, Mo.
Well, it's been a while since we had you on for a podcast. You had a lot of stuff going on at your end. You just came out with a new book called The Silver Manifesto, which is available on Amazon and Audible and also through your website. So how's everything going?
Well, it's been a bit of a slug, as we all know. Anyone that's been, around the precious metals, the metals have been deteriorating in price for quite some time, although it looks like we finally caught a bottom. It's a little too early to know for certain. And the underlying mining shares are at like 2 sigmas down. In other words, they are like at the lowest low they've been. It's almost insanity what's going on in the HUI, the XAU, and the GLD, excuse me, the GDX. But nonetheless, this is opportunity. I mean, it really pays to be a contrarian, and you almost have to be a contrarian to the contrarians to be involved in the market at these levels. But these are the levels that I think will, a few years hence, be very, very, beneficial to those that have the wherewithal to get in or stay in. I mean, a lot of people in this sector have left, and there's some diehards such as yours truly and others that have stuck it out. And if you have any means to be able to, purchase at these levels, again, I'm repeating myself for emphasis, I think 2 to 3 years out, you're going to be extremely happy. I mean, these valuations that are unbelievably low relative to the assets that are supporting the companies, these mining shares, I'm talking about producers, mostly in the streaming companies, are gifts, if you could see it. But again, bottoms are made by people not wanting to buy. And that's why they keep going lower in price. And, of course, the underlying price of the metals as well. So to sum it up, buy is what I'm telling my people. I mean, this is probably about as low as it's going to get. Is it going to get lower? I would say probably potentially could. But if you take a accumulation approach and buy over the next, let's say, few months, I don't think this 4-year bear market can go much longer. And my neck's out there on the chopping block, which I don't really like to do, but it's part of what I do. And I said by the end of October, I think there'll be enough of a shift in sentiment that people that are in equities will start to question them, and there'll be some strengthening in the metals markets. And we're halfway through the month, and we're right at kind of the turning point. We're at the 200-day moving average in silver and really haven't broken through very strongly. And we've come up to the average in the S&P index. And so if the S&P turns down from here and silver turns up from here, then I'll feel, vindicated. On the other hand, you could go the other way, and I won't be.
Also,
go ahead.
I'm saying the U.S. dollar index suffered its first death cross in over 2 years as well on the chart. So a lot of interesting things going on, and gold is at a 3.5 months high. So there's some momentum going on in the precious metals market.
Yeah, I'm happy. I think I'm correct, but it's not about me being right. It's about the market and what we can do about it, and when we can get in and get out. And I've been super oriented toward the precious metals practically my whole adult life, and then specialized in silver, as everybody knows. And I do still think that all the basic premises that laid the foundation for why you would want precious metals, and then after that establish a position in the mining shares, is still valid. I don't think anything has invalidated those premises. In fact, I think if you examine them carefully and objectively, there's probably more reason than ever to be in these metals and, again, the underlying mining shares. So, and that's not because I'm stubborn. It's because objectively it's due to the fact that the financial system is in such a precarious situation right now, and there's really no way out for the Federal Reserve or any major central bank, let alone even the Bank of International Settlements, the Bankers Bank, I mean, this whole system is based on something that's basically a fraud, and and the game is up. I mean, a lot of people, not only the local level, I mean, the basic citizenry of the planet, some fairly significant percentage understand it, but on up from there, going to the top tier, understand that something is drastically wrong with the system, but everybody's trying to pretend that it's going to be okay. And every day almost that it's this pretend and extend, as James Sinclair refers to it, it's getting very, very difficult to do it because people are realizing it's not working.
And if it wasn't for the paper market, we'd be talking about gold being above 2,000 and silver being above 50, because the demand, the fundamentals in that market have been off the charts. There's been a period of time where the demand slowed down a little bit worldwide, like it has in the past couple months in China. But ever since the correction in the gold and silver market, the demand has been consistently been high. So if it wasn't for the paper market, we would have a lot of money in our bank account compared to today.
Well, I think they'd be significantly higher. I don't know what the exact prices would be, but I agree that if there was a cash-only market and not a futures market or a paper market that can supply the demand with a piece of paper in some instances, and some of those instances are more often done than most people realize. Because, well, I never had a futures account. Yeah, but you had an account with XYZ entity called Morgan Stanley, and they were storing your silver. It turns out they didn't have any silver at all, and they were charging their clients storage fees. So, that had nothing to do with the futures market, yet that was paper silver that didn't exist. And so, this is a little more pervasive, and I don't want to make everyone fearful that, anything that they have on paper at a certain brokerage house or whatever isn't there. I'm not saying that. What I'm saying is, that you got to be careful, and that your core position, I think you should be able to go touch it, or at least be able to see it. But again, yes, you're right, Mo. When you can satisfy demand with a promise to pay or a certificate or something along those lines, in other words, some kind of paper hypothecation on the underlying asset, or use the derivative as a substitute for the actual product, then you get into this sketchy area. And, we've seen this, these different bullion dealers that have had problems here of late. Tulving was some time ago. I mean, Tulving did probably like $1 billion in sales. I mean, they were huge. By the way, I never recommended Tulving. If you go back to my original 10 rules of silver investing, rule, I don't know if it's number 8 or not, but it says don't get a raw deal from your dealer. Why would I say don't get a raw deal from your dealer? And what I went on to explain on that, it's available for free of anybody that gets on our mailing list, is that sometimes price only isn't the best thing to shop for. That sometimes when you get a price that's so low or so close to the wholesale price, you have to question how that is being accomplished. And of course, Tulving, and I want to badmouth anybody, but a fact is a fact. He went out of business, and there are people that are still waiting for their metal and never get it. And that's in that investing rule, not him by name, just dealers. Because I've been through one bull market from bottom to top, more or less. I mean, I didn't have much to invest, but nonetheless, I was in the market. And I watched some of these dealers in the last bull market that couldn't produce what they'd promised. So, didn't want anyone that read my work to not benefit from it. Not that I haven't made some errors. Certainly I have. But when it comes to paying for physical metal, you really should take delivery of it. And if you don't, you really better know who's holding it for it, and at least go check it out, or have somebody go check it out. Because this situation right now is where there's a lot of retail demand, and it can't be satisfied in real time. It's a delayed situation, 4 weeks, 5 weeks, 6 weeks to wait. And I get that. And I think anyone that's in that waiting mode is going to be fine. But there's a propensity for some dealers and to say, well, I've got all this stuff stored over here, and I could take some of it off the shelf and fill these orders, in the next 3 weeks and just wait for the silver to come in and replace the stock. And once they do that once, look out, because then they're on that slippery slope.
So, are you surprised by how long this correction has gone in the gold and silver market? Do you think this is a natural correction, or do you think there's some external factors that prolonging this correction, that this correction might have been over sooner rather than later, due to some pulling string by a couple of big banks?
Yeah, I think it's an unnatural market. I mean, again, I don't like to use the manipulation card too often. I think it's something that we have to accept as a part of almost all markets, if not all markets. But after we made the run up to 48, and I did get the top, and I'm grateful I did, because a lot of people were depending on me, and some have retired and never got back in the silver market. I've gotten some nice accolades from some of these people because they were leveraged and they got out and they're done, they're retired, they're just thanks a lot, and they probably will never come back in the silver market. Good for them. But the point I want to make, going directly to your question, is after I kind of backed off and took a good look and watched it drop and move around the 30s, in the mid 30 range, I said, that kind of a move, even if it's silver, if I try to be objective and look at the chart and say, okay, what's that going to take? And the answer to that question is 2 years, maybe 3 at the most. Now, that doesn't make it right. It's an art form. It's not an exact science. But that's what that kind of a run in any commodity would usually do. And under the conditions we are with the financial stress in all the markets, I thought, it was closer to 2 than 3, and 3'd be pushing it because, the fundamental facts of the problems in the financial system, the banking system, the brokerage system, the settlement system, and not talking geopolitics at all with all the, war drums going, that the fundamentals were just too strong. And, of course, I'm wrong. It went 4 years. Well, why? Well, I think one of the things, and I did catch this one, and a very important one, was when silver had bounced off the $26 level for so many times, and gold had done it around the $15.50 level, and really showed an extremely good floor there. But the last time I saw it wasn't going to hold. So I made a update video, which I do for my premium members, and I did that a few days ahead, but enough ahead to some of the fund managers who follow our work decided to hedge, and they were very grateful they did. To me, that 26 level in silver and the corresponding about $1,550 in gold was a psychological boundary that was very beneficial to the banking establishment, because at those levels, once they broke through them to the downside, basically the psychology shifted. Most of the people that were like neutral to positive, gold, silver, maybe just use it as I teach, 10% of their portfolio or 20 at the most, they had lost faith. And from that time until present day, there's been, again, repeating myself, a mass exodus out of this sector. And a lot of people that thought that they might want to be in the sector that never entered it, as an example, probably won't come into it, even though it's screaming buy now. It's because they saw, silver couldn't hold 26, and not that they're technicians. That's not what I'm saying. Those are the levels technically, and I'll put my reputation on it. That's not the point. The point is the psychology shifted from, geez, we ought to own some gold, Martha, or, you know what, it wouldn't be a bad idea to have some silver, or, those kind of thoughts, to, I don't want anything to do with these metals. And by keeping it under those levels for so long, it's just gotten to be more and more disheartening to even people that thought, well, that's okay, I could buy silver under, 25, I'm doing fine. And I think in the long term, that's a great idea. But now that we've been in the 15s, it doesn't look too smart to be buying it at 25.
And that's a great point. And we were talking about the mining stock for gold and silver for a little bit. I just wanted to ask, I don't know if you have this number in your head or in front of you, how many went bankrupt since the gold and silver correction?
I don't have that number. It'd be better to get somebody that specializes more in the junior sector than I do. We spend a lot of time there, but we don't do a lot of recommendations there because it's a very difficult game, and you you make big money in big companies. You can make big money on small bets or in junior companies. There's no doubt, but most people play the game wrong. And what I teach is to bet a little to win a lot, to diversify. But back on point, I don't have a number for you, but what I can tell you is that a lot of companies are out of business. A lot of companies, I wrote an article jokingly, but it's true, said a lot of mining companies have gone to pot, which I'd play on words, because a lot of companies that were exploration mining companies became marijuana companies. So I don't know, Mo, what numbers are, but it's significant in the junior space. A lot of companies that were in, let's say, the mid-tier space are put on hold. The projects just don't carry water because of the economics. With silver at these levels, they can't mine it economically. And let's face it, any business, be it a silver miner or someone that makes dresses or someone that manufactures automobiles, is there to make a profit. And if you can't make a profit, you're not going to go into business. So a lot of those are on standby or hold. And then a lot of the base metal miners have basically backed off because the main driver for all the commodities pretty much was China, and of course they're having their own issues. So a big number. What percentage, I don't know. What amount of miners, I don't know. But I'm sure somebody out there probably has a good number.
Yeah, I was asking you because I was reading articles and people were throwing numbers between 700 to 900. So I just wanted to see if you had any insight on that.
Well, I was going to throw 1,000 out there, but it was more of an educated guess than true knowledge. So, and even the 700 and 900. But that's a pretty good idea. Where we were. I mean, you have about a 1 in 4,000 shot at a junior exploration company actually making these significant, money. And so those aren't real good odds. Whereas if you buy at the right time into a producer or a mid-tier producer and the price goes with you, I mean, you can make significant money. I know it's really difficult to say that or to see that at this point in time because, again, the market's so beaten up. But this is a place where you really want to do that because the companies that have survived are there for a reason. And, of course, you can't just willy-nilly pick anything, although at this point you almost could do that. But that's another story. Regardless, you pick well-picked companies at this point and don't leverage, no margin, and hold on with a 2 to 3 year horizon. I think you do really well.
So where are you putting your money right now? Are you putting it in junior mining with upside potential once gold and silver goes back up, or are you putting it in undervalued senior producers or mid-tier producers or the royalty streaming companies?
A little bit of all of them. Lots more physical at this level. We're on the $16 level. That's one. On the speculative side, we get stuff that crosses our desk all the time, and a lot of it just goes in a round file, but I look at everything, or darn near everything. And there's one that's a technology stock that has to do with the mining industry that I think could be rather significant. Unfortunately, after we went out and did all our due diligence and actually wrote the report, there's going to be some restructuring. And when that happens, you have to sit on your hands because, one, you don't even know what the entity's name is going to be. You don't know what the stock structure is going to be. You don't even know what the symbol is going to be. So I'm stuck right now with that one. But I had put in some small amount in the beginning of it, and I'm just sitting on that now. Once it goes the way we expect, and I have to be very cautious what I'm saying here, if it comes to fruition and is restructured and becomes a publicly known entity, then of course we'll issue the report for everybody's benefit. But on the streamers, we still like the streamers. I mean, you asked me about, did I think silver could go this low without some help? Probably not. As far as Silver Wheaton's concerned, that's probably, I'd give the same answer to that company. I mean, seeing that company this level, I mean, even one of the stalwarts back in the initial run-up for the first decades, Silver Standard, I didn't think you'd be seeing it at these levels again. There's a lot of them out there. I mean, Goldcorp. I mean, come on, Goldcorp was like outperformed Berkshire Hathaway for a number of years in a row, and now look at its price. So, it's one of those ideas that you've got to be able to time these things. And, although I do time position trading like in the futures markets, on the stock side, we kind of look more at the fundamentals, although we definitely look at the technicals as well. In fact, David Smith did a great article on silver wheaton suggesting to our members that it could get to these levels, and lo and behold, here we are. Point I'm making is whenever someone comes in as a new subscriber, you don't know where they are, and you can't give individual advice. So, if something was a really good buy fundamentally at 10 and it's now at 8, I'm going to put it, still think it's a buy. But what we've done with Chris Marchese's help, as you know him better, know him well, not as well as me, but so we've revised that whole methodology, and now we have a numeric system that basically says, strong buy, hold, that kind of thing. So you get like a numerical value. It's a little more objective than just buy, sell, or hold. So it gives you, okay, and I'd always done that in the top tier, by the way. The top tier companies always said these are the top 3. I didn't give them a numerical value, but I could always sort through using my metrics on which are the 3 strongest companies in the top tier. And these are, the Franco Nevadas, the Silver Wheatons, the Royal Golds, those type of companies. And that was actually pretty easy to determine. And had you rotated in those top 3, you'd still actually be looking pretty good today, basis the fact of when we got into those companies such a long time ago. But probably rambling on here a little bit too far, Mo, but you go ahead and bring me back on track. We'll continue on.
It's okay. So I want to talk about current events that's going on in the market and the economy. One of them is Glencore, which is commodity related. A lot of talk about Glencore. A lot of people are comparing Glencore to Lehman Brothers because of the amount of derivative and debt off the books and on the book. I read an article a couple of weeks ago on Zero Hedge saying that Glencore may have over $100 billion of debt not accounted for. So I want to ask you, what impact will Glencore have on the market and on the commodities market as well?
Well, quite an influence. I mean, we looked at it from the aspect of, kind of objectively from, what Reuters and Bloomberg and the main news services were saying and digging through that stuff. And then going a little deeper, and then Bix Weir had insights on the Mark Rich company that became Glencore, and Trafigura, how it related to Glencore. And if you just read the Glencore website, which I did before we published the last issue of the Morgan Report, it's obvious that they have their fingers in almost every commodity out there. And a lot of these commodities don't have an exchange, like the tin market, for example, aluminum. I mean, there's a lot of metals out there that trade with no, transparency. And Mark Rich, if you read, I think it's called The Metals Men or Metals Man, I forget which, talks about, what he did and how he did it and that type of thing. And so it's very, very worrisome to me without knowing really all the facts. But the facts that we do know are they're in like 80 or 90 commodities, and they have a huge derivatives book. And whenever you say derivatives, that worries me because, Glencore might be just fine, but they might have relationships with other counterparties that aren't so fine. And maybe they can't deliver or they can't make payment on a note or something along those lines. And since most of these things are interconnected, it's very worrisome, again, that something that doesn't seem like it's that big of a deal can turn into a big deal because, again, there's so many vectors that point to the same place and at the same time. And some small thing that goes wrong can affect a lot more than people might think on first glance. I mean, another heads up is, the Rio Tinto CEO Walsh said he's not interested in bidding for Glencore. Well, what does that mean? Well, he probably knows more than me, but he probably knows the fact that this derivatives book is probably pretty cumbersome and pretty hard to unwind, and it's something that he doesn't think that Rio Tinto wants to get engaged in. And I don't blame him. I certainly wouldn't. So I want to go on the positive side. About 3 days after I wrote or published the Morgan Report, I got a call from a guy that worked for Glencore for a number of years, and he worked in cobalt and something else, another, metal that isn't really, on any exchange. And he told me that, they're fine, even though he didn't work for the company anymore, that, they are just huge and all that. So, Mo, basically I'm telling you, I'm kind of in the middle. I don't know. I am concerned about it. And I'm also in the, about the Lehman thing. Back to your question. It might be one that gets saved. It's one of those, it's too big to fail. So, we got to help them out. And I'm
Yeah,
not
I did a
saying,
lot.
yeah. So I'm watching it carefully. I've given you my opinion. I don't really know all the facts. I wish I did know more, but I get a very uneasy feeling about it. I'll put it that way.
Yeah, there's a lot of counterparty risk regarding what's going on at Glencore, because a lot of people will be affected if they went down. And the way this company was formed, it's very interesting. The background of this company, you mentioned Mark Rich. This guy was in jail for racketeering and fraud charges. He's supposed to spend about 300 years in jail, and then Bill Clinton pardoned him right before he left office. And then he went out and started Glencore, and then his buddy, that the CEO right now, his name is Ivan Glasenberg, which he's still the CEO. He was with Mark Rich when they started this company, so that's very interesting.
Yeah, and the guy that did Trafigura is like dead, like a couple of days after this Glencore news came out. I mean, it smells kind of fishy, let me tell you. But again, I don't want to put my neck too far out there. I don't want to alarm anybody. I don't want to be an alarmist. What I want to state is that there is so much in this derivatives world that is going to take down the system. Mostly, it has to do with counterparty risk and defaults. These default swaps that if somebody goes bad, someone has to pay, and that's what happened with the financial crisis of 2008. AIG was the kind of the backer of last resort that was going to pay off if some of these bets went bad, but they couldn't. And so who got bailed out? Well, a lot of people got bailed out, but AIG was one of the ones that got bailed out so that they could pay on the on the bets that went south. So this, has been troubling to me for time I was, a young man. And back then, I mean, about the worst you got was like an options on a futures contract. I mean, the exotic, and not that there wasn't some over-the-counter party, undisclosed optionalities, I'll call them, going on. There were, but not to the degree that they are now. I mean, these things are just so exotic, so convoluted, so complex, and so interrelated to each other that it's an accident waiting to happen.
Yeah, I just find it very interesting that this guy got pardoned by Clinton on the last day in office. And we're talking about a guy that made illegal oil deals with Iran during the Iran hostage crisis, and he had federal charges of tax evasion, and yet Bill Clinton let him go from jail. And he went out and started this company, a multi-billion-dollar company, and look at it now. It's doing a lot of shady stuff, and now it's about to blow up.
Yeah, well, it's sort of par for the course, isn't it, Mo? I mean, when you go to Professor Black, who's, I think, super individual and is about as straight a shooter as they come. I mean, I don't want to misquote him, but I'm pretty sure he said something about, basically it's a criminal cartel running the financial system nowadays. And that's right. It's just a very sad state of affairs. And these people feel that they're so powerful that nothing can stop them. And, and the Justice Department is not doing its job, and the regulators aren't doing their job, and they're getting away with it more and more and more. They become even more emboldened to carry on with business as usual. But what you just said about Mark Rich, I mean, that's, was that the beginning of the corruption? I don't know, but it certainly added to it. And now, not that that's small potatoes, it's huge. I mean, Glencore is a huge, huge company. But, it's not just one. It's not just a Glencore. It's pervasive. It's throughout the system.
And that's right. So I want to shift gears here and talk about the market for a little bit. Now, if you look at the earning guidance for the past couple of years, it shows that companies are beating earnings, but they're beating it through stock buyback and earning revisions. So what does that tell you about the market and the economy? Like, for example, Johnson & Johnson yesterday announced they're going to do a $10 billion buyback, and we're seeing a lot of companies before earning, they make their revision and they revise their earnings down just to show that they can beat earnings. So what does that tell you about the economy and the market?
Well, to put it in graphic layman's terms, it makes it very, very clear to everybody a snake can only eat its own tail for so long. That's what it tells me. I mean, that's a great metaphor, a snake eating its own tail. And I'll go one step further because this is something that you know, Mo, but a lot of people don't. But a lot of these big, huge, stalwart corporations like General Electric, for example, and I haven't done this analysis in a long time, so this may be invalid for 2015, but it certainly wasn't invalid some time ago, that a lot of these companies like Ford Motor or General Motors or General Electric, these companies actually wouldn't be in the black if they didn't have financing arms. A lot of these companies that manufacture, product, basically by the manufacture of the product, they can't make a profit. The only way they make a profit is they have this huge financing arm. So these companies become financing companies is what they become. You've got GMAC and you've got GE. I mean, GE is a huge finance house now. So they're basically making money by loaning money and getting interest on money. And that's what happens at the top of these systems before they collapse, is that everything's done on a financial basis. I mean, most people that are listening to this show have no idea who Elliot Janeway was. You might look him up on Google, and I haven't. You might, get some interesting reading. But what he said was, well, when we get to the end, when you and I are trying to sell life insurance policies to each other, we're in big trouble. And that, again, as a metaphor, is that, when there's no productive capacity and you're not really manufacturing things that you absolutely need to survive or, make your life better or really more productive or whatever, and all that you got left is financial instruments. And financial instruments are the only thing that are being, bought and sold, that you're in trouble. Because that's a financial system. It's not an economic system. There's a big difference between a financial system and an economic system. An economic is the physical economy, which means how much food can you grow and how much energy can you produce and how much does energy cost per capita, and are you increasing your energy usage or aren't you, and are you really making things better, are the iterations of the telephone, which has obviously gotten better and better, so that's a very positive thing. How about energy conservation? What about pollution? What about all these other factors? So you look at the physical economy, and if you see that's getting better, then the financial markets in more honest days would reflect that. But at the end of these systems, it's all about pushing paper at each other, and everyone's going to get rich because I've got all this paper. I mean, another way to look at it is if you looked at, if you wanted to make, let's say, 35, 40,000 a year retirement income, at today's interest rates, what kind of bond portfolio would you have to have? Well, something like 40 million. Oh, wow, 40 million to make 40,000 a year so I can live off the rest of my life. I mean, 40,000 a year isn't a huge income. But at today's interest rate. So what does that say? Well, if you looked at it from that lens, through that perspective, what it says is we've had a hyperinflation. It just hasn't gone into the public domain yet. So there's lots of ways to look at these things, Mo, and one of my basic premises is to get people to think, to question things, to evaluate them for themselves. But I think we're getting close. And close to what? Close to where this fiction of financial system isn't going to carry through much longer, and some of the cracks of reality shine through.
Yeah, it's one thing to beat earnings through increased net income and revenue, but it's another thing to beat earnings through stock buyback or earning revisions. To me, that's not a healthy company if they beat earnings in that way. To me, that's earning manipulation when you do stuff like that.
Yeah, snake eating its own tail. I agree. It really is. It's deceiving, but Wall Street seems to love it. I mean, there's television channels that basically do nothing more than cheerlead for Wall Street.
Yep, yeah, I agree. So one final thing before I let you go, I want to talk about politics for a little bit. And, with the election not really around the corner, but it's in the near future. And we already had many debates with the Republican, and we just had one last night with the Democrat. Now, I have seen none of the debates on the Republican and Democrat side, but I've seen sound bites. I've read articles and I've seen quotes, and then I think it's scary to see the amount of support Bernie Sanders is getting at the polls since he is a socialist. But then I thought to myself, well, all these candidates are socialists. I mean, they all want big government. They all want to spend. They all want to increase tax and regulation. So he's no different than any other candidate, even on the Republican side. But what did that tell you about people that still haven't woken up ever since the financial crisis?
Well, you put me on the spot, and that's okay. I mean, basically, my interesting point of view is that is my metric for how I find out if somebody's really awake or not. So if somebody says that, Party A or Party B is going to, resolve some of these issues and things will be better, or real change will take place, then I discount what they have to say to me quite a bit. If somebody says that it doesn't make a hoot whether Party A or Party B gets elected, that it's just, two sides of the same coin, and that the agenda is basically the same for both parties, then I consider them to be awake and aware. So that's kind of how I look at it. I don't think that there's any way at this point that the system politically can really do very much to really right the system. There isn't any strong leadership. There isn't anyone really willing to tell the truth. The whole situation, from my perspective, is political theater. They're not talking about, big problems. They never talk about, the monetary issues in any significant way. They never talk about what's going on in the environment in any significant way. They don't talk about anything as sacrosanct as, Monsanto and the GMO foods and what they're doing for the health of the average citizen. They really don't address anything of substance, of substantial merit for the average person in North America. They're more interested in what I call the Big Daddy syndrome. And unfortunately, a great portion of the population wants a Big Daddy. They want somebody that's going to take care of them. They want someone that's going to promise them that they're going to get something. And even if they don't think it through, a lot of people are looking for something for nothing, even though, they work and they do this and they pay that and all these other things. But the idea of democracy where you can live off of somebody else's efforts only lasts as long as it possibly can until you bankrupt the system, and the system is basically bankrupt now. So can it go on further? You bet it can, especially in a fiat system where you can continue to have quantitative easing. But again, it goes back to what I said before, where you have to look at the physical economy versus the financial system. And when they're so much they're so far apart at this point that as it continues on that path, the physical economy is actually deteriorating overall. There are pockets that are doing fine, and I understand that. But the financial system continues to accelerate. More and more people are in the, working in the financial system. Well, the financial system doesn't really produce anything. It doesn't, other than quote unquote money, and I put money in quotation marks because, what is money? Well, that's another discussion. Anyway, I think I overspoke it, but I really do think that this is political theater. I think that it's entertainment. I don't think there's anybody. I'll comment on Trump. I think it's really refreshing that someone can just stand up and, say it with some chutzpah and just get on with it. But I don't think he can make any real significant changes, and he's certainly not addressing, in my view, this is my interesting point of view, any real significant problems. He doesn't really talk about, deficit. And, the president isn't responsible for the economy. The president is responsible for jobs. The president's responsible for limited government. Making sure, the whole thing is tragic is what it is. It's truly, truly tragic. And again, repeating myself, we haven't had any real strong leadership in a very, very long time. If you ask me, in my lifetime, under what president do we have strong leadership, I'd say JFK, John F. Kennedy. I mean, he had some real substance, and he had real change. I mean, he was going after corruption in a big way, where they named names and pointed figures and took them to court, and he wanted substantive change in the monetary system, taking the Fed out of the system for a brief period of time with Executive Order 11110, and having the Treasury print the currency of the United States. And they printed some, I think, 2s and 5s. I have a 5. In fact, I have more than one. And then, he's gone. And I think that sent a very clear message from my perspective, that anybody that really wanted to do anything really substantial in the political system or for the country at large was taking a real risk. And what I mean by real risk is what I just stated, the risk where you may end up dead. But, that was a man of principle as far as I'm concerned, but I don't think you're going to see that today. I mean, it's almost impossible. As far as I'm concerned, the president's kind of a middle management position. They're just sort of there to kind of get on TV and make everybody feel good or not feel so good, and tell us why we're doing what we're doing and where we're doing it, and it's okay, we should be doing it. But that's just a middle management position. They're basically working for a higher authority, and I don't mean God. And they are basically directed, more or less, for what they do. They have a very small bandwidth of what they can actually say on their own.
Yeah, JFK had potential to do some good change to the country, but he was only in office for 2 years, I believe, before he got assassinated. So it wasn't enough time to get anything done, unfortunately. But David, I'd like to thank you for coming on for a podcast and talk about your book, The Silver Manifesto. If people want to pick it up, what's in the book? What would they find? What do you guys talk about?
Well, Mo, it took 9 years, sorry, yeah, I'm a little tired. It took 9 months to write it, Chris, but we wanted to make sure that we got, almost everything in there and a lot more than just the silver market, because we thought it was really important to understand the financial system, as, we've been talking about on your program. And because of that fact, we put in those type of chapters. But we started off basically looking at silver as money and looked at it from its use from 3200 BC up to the Revolutionary War. And then we went through it in detail as the primary money in the United States, because the 1792 Act is based on the silver standard. And then we talked about supply and demand, which in depth, and then we went in, as I said, in the money and banking, so people understand fractional reserve banking. Then we went into the price suppression modality, and you can't really understand that unless you understand fractional reserve banking, which most people on your show probably do, but we went into it in a kind of a piece-by-piece method. Then we went into the Austrian business cycle versus socialism versus capitalism. And then we talked about what's going on in the financial markets, and then we ended that whole part with the debt bomb and what's going on with this compound interest monster that can't get away from and is continuing to distort the markets more and more and more. Again, going back to what I said earlier, if you really want to retire $35,000 a year, you've got to have about 40 million in bonds, and I don't know too many average Americans that have that. So then we went into chapter 10. This is worth the price of the book alone. It's how to build a precious metals portfolio, because we take you through exactly how we do it. You do is in sensitivity analysis and everything else, which most people are not trying to talk over their heads. I'm just trying to give you the quality of the book, so someone that knows what I just said might want to pick it up for that reason. And then I went through and appraised a couple mining stocks and showed the reader how to do it. And then the last chapter is Beyond Silver, and this is the one that I wrote primarily, and Chris and I worked on the rest of them together. And the Beyond Silver is basically asking the kind of questions that are more philosophical, like, what's really going on in the monetary system? Do we need money? If we do need it, does it need to be honest? What are these problems that we're facing as human beings, and what can we do to rectify the situation, a little bit on the politics. And I quoted 3 different areas that I thought were fascinating to read, and I noted them in that last chapter. Not saying, oh, this is the one to do or that's the one to do, again, with my basic premise to get people to think, but rethinking what it means to be human and how we should treat each other and how we should live together and how this whole human experience could be bettered from a lot of different perspectives. So that's it. Thanks for asking. Definitely loved writing it, and feel good that it's over with. I'll tell you, there's a lot of work writing a book.
Yeah, I bet. It took you 9 months to write that book, you and Chris. And I just bought the Audible edition yesterday, so I look forward to listening to it on audiobook. And maybe next time we could have you on, we can talk about the book.
Great. Thank you, Mel.
All right, well, thank you, David.